Hi, everyone. Welcome back to part 2 of Module 2 in the capstone course for summer 2021. Again, my name's Don Buder. And in this part of Module 2, we're going to be looking at key commercial relationships, kind of the foundational elements that you're going to have in your early stage business as you build it. And we're trying to identify all the pieces inside and outside your organization that are going to support you as you grow the business. So the first foundational element, and we just want to kind of clarify some terminology here, is your customer versus the consumer. So the customer that you're selling to, presumably through grocery or online or e-commerce, is the person who, or the platform that's going to be selling your product to the consumer, the end user. So when we use customer and consumer, the consumer is the person who is actually consuming your product, and the customer is the next chain in the stream of commerce who's going to get it from you and sell it to the consumer. So when we think about the customer, and this is Whole Foods, it's your local grocery store, it's Amazon, we have to determine how they decide to take products like yours. What's the decision-making unit? Who do we have to get to convince them to take your product and put it on the shelf or on the e-commerce platform? And that investigation is critical. You'll waste a lot of time if you don't identify the decision-making unit that is applicable for your product, the kind of product that you are trying to sell to them. And then we start thinking about how we map the process to acquire a customer. So what's our plan? If we're selling to Whole Foods or think we'd like to, what is our plan to get to the right person? How are we going to organize our sales presentation? What do we want to pitch? We really have to focus on that part of the process because that's the most important sale to start the pipeline here. We have to sell to the customer so the customer can start selling to the end user, the consumer. And this is kind of an elaboration of that. We go into a little bit more detail in mapping out the sales process. Again, what are we going to do to sell this customer on our product so we can get our product on their shelf or on their e-commerce platform? We have to be very thoughtful about that. We have to get input from others that we'll talk about through the rest of this module. But the strategy is going to be critical in designing a process that will lead to the success of your company. So the second foundational element of this initiative or this undertaking is pricing strategy. How do we price our products? So we have to start by knowing what our costs are. And we can't be selling our product at less than it costs for us to make it and get it on the shelf or get it on an e-commerce platform. There may be times when we might need to do that to get a certain amount of velocity or acceleration, but that's not a sustainable business model unless you're Amazon, which has not been profitable, I believe, until the pandemic, but was building tremendous value by increasing its customer base and bringing in investment dollars to support that. But that's not our world, at least for the moment. And so we need to know our costs so we can set our price at a suitable price point above that. And then we need to know what the prices are of the alternatives to our products that are on the shelf next to us, that the customer, the retailer, or the consumer, the end user will be looking at and say, well, maybe I'll take that one instead of yours because that's cheaper. So we have to know what the competitive landscape is in terms of pricing. Customer acquisition cost is a concept that you'll hear a lot in this business. What does it cost you to acquire a customer? And that's your marketing costs, and your online presence, and the other outreaches you have to bring a customer to your product on the shelf or on the platform, and to persuade them to buy it at that point of sale. And knowing what it costs to acquire a customer is something that we need to understand, in addition to knowing what the costs are to produce our products. We have to layer that on when we think about our actual cost of getting the product into market, and determining how we set our prices so that we ensure we have a profit margin. And costs are always one factor, maybe the most important factor in determining price, but not the only factor. So again, the competitive landscape, what the alternatives are for your customer in this category is another factor. If other competitive products are at a higher price point and your costs are low for whatever reason, this might give you an opportunity to set a price where you'd still be competitive in the market, but you'd have a higher profit margin for each unit that you sell. So that's why we say the cost is one factor, the market or competitive landscape is another factor, and we try to land somewhere in between. Again, this is the name of the game in running a successful business, knowing that your products will be profitable, or your services, that your pricing and cost structure allow you to be profitable. And that profit is called gross margin, what your gross margin is on each product. Now, gross margins differ dramatically in the two industries that we're looking at in our class. CPG, consumer products, and food products on the shelf. You typically have a much higher gross margin, need to have a higher margin because of the cost of distribution and getting a product onto the shelf. And typically, food companies are looking at somewhere in the 30 to 50% range. Some are a little bit higher. That's unusual, but that's a necessary product margin in that stream of commerce. In the restaurant industry, gross margins are much lower and usually less than 10%, somewhere between 5 and 10. And that's just the nature of labor costs and the like in the restaurant industry. But we definitely have to know our gross margins, because if we don't have a gross margin, if we don't have a profit margin, we're not going to be able to survive. It's not a sustainable business model. So the key commercial relationships you're going to be relying on to develop your pricing strategy and making sure that you have a healthy gross margin within your stream of commerce is your CPA. Your board of directors may be able to advise you on this. And if you're involved in business incubators or accelerators, if you decide to participate in any of those programs, those advisors will be able to help you develop a pricing strategy that ensures and protects your gross margin in your business. So now we move into the third foundational element, what's your sales strategy. The key message here is get out of the building and sell. We can't be in our offices, even though during the pandemic we had to be, but now the world is opening up again. We have to get out, talk to customers, talk to consumers, and go to trade shows, go to conventions where retailers and other distribution channels are participating, and we have to sell. So, some of it you do by phone, some of it you'll do by Zoom, but as the world opens up again, keep this in mind, get out of the building and sell. So this question of who are our channel partners and what lanes are we going to be in is very important. Some of you that are doing food products may only be in grocery, you may only be in independent local grocery. Some of you may be at Whole Foods. So we'd have to pick the channel partners where we want to be. And some of you will want to just be selling online, either direct to consumer from your own website or through Amazon, perhaps, or Thrive Market, other online platforms that sell grocery products for emerging brands. So this is a question of picking your lanes. What are your lanes of distribution? What lanes do you want to be in to reach your customer? And knowing what you know about your customer, what lanes do you need to be in to reach them? We have to think about market size in terms of what our sales strategy is. And maybe some of us have relatively small markets for our products. That's fine, no issue with that. If it's a larger market, we have to be able to start to quantify it and understand it. But kind of sizing the market on the front end gives you a sense for, again, the kind of team you're going to need to support it, the kind of capital you're going to need to raise to grow the business, and having a realistic sense of the market size of your product or service is important over time. That may change, the market may change, it may evolve, you may develop a larger market than you originally intended. That would be good. But going the other way of thinking you have a huge market and then realizing that it's a very small market is going to be a challenge, certainly if you're trying to bring in investors who might be disappointed with that outcome. And once we know the market size, we have to think about what our share of that can be. So if the plant-based yogurt industry is X billion dollars, and what do we think our product, plant-based yogurt product, is likely to be able to generate in revenue every year? What relatively small percentage of that is realistic for us to attain? Again, which channel do you focus on? You can't be all things to all people. So yes, you can be online or in e-commerce and also in retail, but you have to think about how many hours you have in the day and where the biggest bang for your hour is going to be. So prioritizing the channels and thinking about which are the best maybe to start in and which are better to grow into later once we have some market traction. That's an important exercise to go through. And then the question of, do you stay local? Do you grow regionally, nationally, internationally? It's great to have aspirations that are large, but we have to think about a strategy that lets us get from A to B to C to D. So let's think about how to connect those dots and what the opportunities are to grow the business, but where we can start it, where we're going to get the most traction so that we can prove to the next level that our product is viable and that consumers want it in the market. So the key commercial relationships here in terms of getting product out to market in the CPG consumer product category, it's food sales brokers. There are many of them that work with smaller companies that actually they're kind of your rep and working with the larger grocery retailers and even some smaller independents, and developing those relationships early on and having them understand your business is going to be an important part of your growth plan. The fourth foundational element we're calling financial management. And this is a challenge with every business, and before you can become profitable in most cases, growing businesses typically have the challenge of making sure they have enough cash so they don't run out of money. So where does the cash come from? We talked about this earlier: friends, family, your savings account, early stage investors, and also from profitability of the product. So we have to mesh those together to make sure that we have enough fuel in the tank to grow. So what are the key elements we're looking at here? In financial management, again, we have to understand the costs of the product, the cost of our sales process, the cost of operating the company. We need to always have a laser focus on those elements. We need to understand our revenue streams. Where's the money coming from? And when is it coming in? What's the time lag between when we sell a product and when we get paid for it? And that differs with online versus grocery retail. Let's make sure we understand that so that the money is landing in your bank account at the right time so that you're not going to run out. We have to have good financial hygiene, which means tight financial management, knowing the numbers, having systems, having a dashboard, having a very clear idea of where the danger points are, where the yellow light starts flashing on the dashboard before you're in the red zone. There are a number of investors who will talk to you about your cash balance and understanding that cash is king in any business, but certainly in the food and restaurant industries. So preserving cash, understanding cash flow is critical. It's going to be important to have financial management systems, and that might be software, it might be QuickBooks, or some other maybe more sophisticated system, but we need an anchor there, a system that we can rely on, that you understand. You don't want to get something that's too complicated for you, and many companies start with QuickBooks and grow with that, but make sure you have a system in place before you turn the lights on for your business. And then the next piece is the team, the financial management team, the people. Do you have somebody inside your company who's watching the money, kind of a controller or an accounting manager? Was that you initially? Do you have the skill set to do that? How do you expand that team, both internally and perhaps externally? There are outsourced financial management services in the food and beverage industry that are very valuable, very affordable for early stage companies, and that's something worth looking at if you don't have an internal team in place. So again, the key commercial relationships here are your CPA. You want your CPA to understand your numbers and to help you understand the numbers. We have the outsourced financial management teams that are available if you need them, and then perhaps starting with one or two people internally that you hired to run that. If it's too early days for you to hire those people, then you have to understand the numbers with an outsourced team until you can transition into internal management by hiring up a financial management team inside the organization. The fifth foundational element we're calling organizational development and hiring plans. This is about how you build a team. This first step is always about assessing your own strengths and weaknesses and where you feel you need support. In the areas of your strengths, that may not be your first hires, but in the areas of your weaknesses, that's where we have to prioritize our hiring plan to make sure that you have people around you internally and externally who can help you run and build the business. And coming up with an organizational chart is always a good idea, and this can be aspirational. So, short term, who do I need and what slots within my organization? And then long term, what are my goals in terms of building a team and what slots will I need to fill to grow? And it's never too early to think about that long-term plan, because it also helps you think about strategic growth opportunities and the people you need to put in place to hire in order to support that and to build the company with you. So we have to set a hiring priority ladder. So who do we need first? Who do we need second? Who do we need third? Those can be tough choices, but we have to be smart about it because we only have so many resources to apply to that. But we have to have the right people in the right places at the right time. So that's worth giving a lot of thought to. You can also arrange to have outside advisors versus internal team members. Advisors are, your board of directors will serve as advisors. You can have an advisory board, which is not like a legal board of directors. They don't have any legal duties or responsibility, but they act as advisors to the company. And many early stage companies set them up and give them some equity in the company to motivate them. But they're your kind of sounding boards when you and door openers when you have specific problems you want to address or opportunities you want to discuss. Always think about what can be outsourced more effectively than hiring internally. If it's going to cost you a ton of money to bring in internal people to do the financial management internally, maybe that's something you want to outsource initially, and then we grow that. We transition from outsourced to in-house over time when we have the resources to do that. But again, we always want black belts here. We want people who really understand what's going on, particularly in areas where we don't, where we have weaknesses, and we want to make sure that they're available to guide us until we can bring in people internally who are also black belts or maybe brown belts who really know their stuff and can advise us again in areas where we're not necessarily as strong as they are. We always want to be thinking about how we incentivize our key employees, and that can be with incentive compensation arrangements, which are cash bonuses. It can be with incentive unit grants, so they get ownership in the company, like stock options as it grows. But we want to make sure we understand what the incentives are that would be meaningful to them. If this is a company that you don't think is going to sell or you don't want to sell, having equity in those companies is not as valuable, attractive to those employees because there's no exit plan or strategy. Those employees may be more motivated by incentive compensation bonuses based on profitability of the company or profitability of their teams or whatever. But we have to understand what will motivate the employees if we want to incentivize them and financially, and we have to design programs that address that. The key commercial relationships here in developing the organization and the hiring plans, there are HR consultants that work with early stage companies that help them build this organizational development plan and a hiring strategy. And there are also search firms, executives search firms, or employee search firms that work specifically in the food and beverage industry that are very well connected and can help place key talent with you. We can talk about those one-on-one discussions if that's a path you want to explore. The sixth foundational element is brand protection. You're going to be creating a brand for your company, whether it's a food company, a food product company, or a restaurant or food service company. There's going to be a brand. And the question is, how do we build our brand, and how do we protect our brand? And as we think about the ways that we protect our brand, that we'll talk about very generally the trademark protection process, and that is the first path you want to be thinking about. If you have a brand that you think is going to be a trademark for your business, you want to register a trademark. The test is, what is the likelihood of consumer confusion? And this is how anyone who's looking at trademarks and trademark registration opportunities or applications assesses either the strength or the weakness of a mark and the ability, a trademark, and the ability to obtain a trademark registration. If you're picking a trademark that is, or a brand, if you're going to promote a brand that is very likely to be confusing to a customer or consumer in the marketplace, then that is not likely to be a productive path for you. And you want to consider pivoting here because that's an area of challenge both in terms of legal complexity and, again, consumer confusion that you don't want to find yourself in if you can avoid it. The one way to find out what brands are protected that have trademarks is that you can do a trademark search. You know, also do a Google search. I mean, I encourage everybody to start there. Just do a Google search of the brand name that you're looking at and do an extensive one and see what shows up on a Google search. And the next level is to talk to a trademark attorney and have them do a trademark search, which searches all the registries of the trademark office in the United States, the patent and trademark office in the United States. And if it's a brand that you think that might have international reach, they can do trademark searches in other countries for you as well. Think offensively and defensively here. Think about what you're going to need to do to protect your brand in a market where there may be competing brands that may look similar to the consumer or the customer, and think defensively as well. Who's going to come after you if you use this brand because they think they've got their turf staked out with trademark registrations or prior usage? So we have to think in both directions when we start building our brand to make sure we have a safe harbor or relatively safe harbor that we're building our brand within. We talked about the trademark registration and application process. That can be done online. It doesn't require a lawyer. My recommendation would be to have a lawyer do it if you have a brand that you think is going to grow, because getting it right on the front end is important. And there's different categories that you file for trademark registration in, and making sure that you're in the right categories, of which there are many, is important. But just making sure that you kind of assess the landscape correctly and know what your options are. Some of you may be able to do this on your own, and others may decide that you want to bring in outside help to initiate and manage that process. There's also a function, and mostly, I know that trademark lawyers do this, they monitor the market. So after you file your registration, they will get notifications of anything from the U.S. Patent and Trademark Office that shows up that, you know, may be within your turf. And knowing who is coming into your turf is important, both competitively and legally. And from the legal side, sometimes it merits sending what's called a cease and desist letter to a competitor who's coming into your turf to say, hey, that's my turf. I have a trademark registration. You're infringing on it, and you have to change your brand name. And that process is ongoing for companies that grow. And that's part of the brand protection process that where we're not just building a brand, but we're protecting our brand as we proceed up the growth curve. So the key commercial relationship here is typically the trademark attorney. If you have a business attorney that you work with, they can usually recommend a trademark attorney that can assist you in kind of developing a strategy here for securing the rights to your brand and then protecting it going forward. Element 7, we're going to call entrepreneurial leadership. And this is about you. This is about making sure that you have a clear vision and purpose, that you understand what that is, that you've thought about it, that you've internalized it, and that you can communicate it effectively to every stakeholder in your business ecosystem. So employees, investors, advisors, other service providers, making sure that, you know, in a very short summary, this is not, you know, you're not going to provide a tome to anyone when you talk about your vision and purpose. We typically like to be able to want our founders, our clients to be able to do what's called the elevator pitch, which we've talked about, the 30-second summary of what the vision and purpose of the company is. So when you enter the ground floor of an elevator in a high-rise building to head up to the office of one of your investors, you can start that conversation on the ground floor, and by the time you get to the 22nd floor, you've very cogently and clearly set the hook with your elevator pitch of what your vision and purpose is. And if you can't get it down to 30 seconds, spend more time getting it down to 30 seconds, because setting that hook is critical in the first 30 seconds in any conversation with employees and investors and service providers and other key commercial relationships. You can always expand on it. You can always have a longer discussion once you've set the hook, but make sure you can set the hook very quickly. Setting goals for yourself, for your company, for your employees. Managing by goals, managing to goals is a critical element of entrepreneurial leadership. And this requires some forward thinking, kind of setting goals with your team and your stakeholders, and making sure that you manage to them, and that everybody has visibility as to how you're progressing to those goals. That's how you build a team. Setting goals that resonate with the team, keeping them informed about progress to the goals, and making sure that's a collaborative effort to reach the goals. And that's a big part of creating a culture. You as the founder, as the entrepreneurial leader, have to set a culture for your company. Think about what you want that culture to be. There are many examples of outstanding early stage company cultures that have been created and have led to really successful companies, and many consider them to be the driving force in the success of those companies. But every founder gets to choose the culture they want to create. Make sure it's clear to you what the culture looks like, and make sure you can communicate that to every stakeholder that touches your business. Communicating resilience is really important as an entrepreneurial leader. There's going to be ups and downs, inevitably, sometimes many times within one day. That's the nature of entrepreneurship. And you have to be able to set the tone and be an inspiration for your team members, that you understand that there's going to be ups and downs, and that the downs are going to end, and there's going to be a rebound, and you're going to get back into the ups, and then repeat, rinse and repeat. I mean, it just happens inevitably if not every day, every week, every month in an entrepreneurial business. But you have to be the beacon of resilience in your company, and you have to be able to communicate that, okay, we'll get through this, and let's roll up our sleeves. We got knocked down, let's roll up our sleeves, and let's talk about how we want to get the train back on the track, and then let's do it together. We want to be able to reward success. Again, this is society and economy where rewarding success is a value, and that is a motivational factor for the other people in our ecosystem, particularly our employees. And so we have to be able to make sure that we're rewarding success at the right times, to the right degree, to maintain the enthusiasm and the commitment and the motivation and the incentive for the stakeholder, primarily the employee, to continue to perform with and for you at a very high level. Sharing credits is always a good idea. I think the best leaders do that. They don't take the credit for themselves. They give it to their team or share it with their team, and that's both internally and externally, how they promote people and or provide PR recognition internally and externally for people who are performing. So don't be a credit hog, be a credit sharer. Your employees will very much appreciate that. Your investors will respond to that. And your other service providers and key commercial relationships will very much appreciate that if you share the credit for the success of the company with them, both in terms of how you describe it and also with perhaps economic rewards along the way. Now, how you do this, how you learn how to do this, I mean, it's not natural or intuitive for some people. Certainly talk to your investors about it. They may have experience in creating this culture and providing entrepreneurial leadership through other investments they've made or other businesses they may have run before they became investors. And or think about getting a business coach. There are business coaches that really provide founders and leaders at every stage of growth with this kind of support as a kind of a sounding board and a problem solver as the companies grow. So think about pursuing those areas of support if and when you think you need it. That's it for Module 2. And we will return in a few weeks with the material for Module 3. And in the interim, I believe I'll be talking with most of you individually as we start building up our business playbooks and start thinking about our presentations at the end of the semester. So thanks for listening, and we'll see you again soon.